Welcome back. So guys, we've looked at GAS, the generally accepted auditing standards. That's the general tip for you auditors, UCPs to go to the field, take a field pick, come back, report all clean and dirty elements. That was in our audit intro session. In the first part of Audit 1, we've looked at the AICPA Code of Professional Conduct. We had a bunch of principles and the very important rules that's going to apply to each and every one of you out here. Now, let's talk about issuers. That's companies which issue securities. That's public companies. Now, in 2001, 2002, in the US, we had a bunch of corporate frauds. Most notable is Enron, which was audited by one of the big five back then. That's Arthur Andersen. Enron had created a whole mesh of special purpose entities and did a lot of creative accounting by recognizing tomorrow's revenues today. And guess what? Arthur Andersen, the big CPA firm, signed on all that and said it's all fine. Investor confidence was badly hit. There was a big question mark on corporate accountability, corporate responsibility, and an even bigger question mark on the CPA profession. Guys, there was trouble everywhere. That is when they came out with a bunch of laws which they call the Sarbanes-Oxley Act of 2002. When George W. Bush, president then, signed this law, he said, this is one of the most far-reaching reforms of the American business practices since the times of Franklin D. Roosevelt. Remember, that was after the economic depression of 27 through 33, and they had a bunch of securities laws coming out then, a lot of reforms coming. So this is one of the most far-reaching reforms in corporate America since then. Now, Bush said that the era of low standards and false profits is over. He said that no boardroom in America is above or beyond law. And truly, SOX makes sure of all that. So SOX has got a total of 11 titles, of which we're going to focus on the first 4 titles which are more relevant for our CPA exams. So Title 1 of SOX. This is the title that created the Public Company Accounting Oversight Board, or the PCAOB. So Public Company Accounting Oversight Board oversees the auditors of issuers. So you have issuers, and Public Company Accounting Oversight Board oversees the auditors of issuers. So if you want to go out and audit an issuer that's a public company, you have to register your CPA firm with the Public Company Accounting Oversight Board. Now the PCAOB has a lot of authority. It does peer reviews. It's got authority for suspending auditors. It can impose penalties on auditors. It can even revoke registration of the CPA firms who do not comply with the rules and regulations set by them. So guys, they're very, very powerful. So PCAOB oversees auditors of issuers. As I told you, the auditors, the CPA firms need to register themselves with the PCAOB. So they become registered. So you call them registered public accounting firms. Now, Public Company Accounting Oversight Board also has its own sets of auditing standards. As I told you, when PCAOB was formed in 2002, they decided to follow GAS. They said, we'll start with GAS, but we need much more for the auditors. So they started with GAS, and slowly they've evolved and come out with the Public Company Accounting Oversight Board auditing standards, which is GAS plus more. Guys, it's the auditors of issuers, much more responsibility out there. So that is what is the Public Company Accounting Oversight Board, created by SOX in 2002 as per Title 1 of the Sarbanes-Oxley Act. Now, Title 2 of SOX talks in detail about auditor independence. Now, we had provisions for auditor independence in the AICPA code. Remember Rule 101? Now, SOX has much more stringent provisions regarding auditor independence. So if you remember, we had auditors' independence is impaired by business relationships. So we said that a CPA for audit or attest services, you cannot provide non-attest services simultaneously. So it was like an auditor cannot do bookkeeping services for the client. You cannot just prepare these financials and then audit them. So the same rules apply here. You cannot do internal audit services. So you cannot be an internal auditor as well as an external auditor. Certainly not allowed. You can't design, implement financial systems. Not allowed. You can't do appraisal valuation services. You can't do management functions. You can't sign checks. You can't do HR services, legal services. So all that impairs auditor independence. Now, I told you consulting. So let's talk about non-attest services. I told you consulting. Under the AICPA code, Rule 101, we said consulting is okay if the client is a non-issuer, the client understands the recommendations and takes responsibility for implementation. Under SOX, consulting services are not allowed to be provided if you're doing audit or a test. Guys, think about it. Doesn't make sense if I'm going out and auditing this client as well as providing consulting services. Let's say I give some advice to the client and that advice doesn't work that well. The client is going to come back and tell me, dude, you gave me that advice, it didn't work very well. Now I can't tell my users, my shareholders that it didn't work. So I need to cook these financials because that consulting advice, that didn't work well. And then I have to relent and I have to say, okay, I'll sign on this because my advice didn't work. I understand you lost a lot because of my wrong advice. Guys, there's a big conflict of interest here. I'm doing consulting as well as auditing. So SOX said for an auditor, it's important that the auditor does only audit or attest services, not consulting. Consulting is simply not allowed. Even in case of Enron, they had noticed that Arthur Andersen got 70% of its revenues from Enron via consulting services. So Arthur Andersen was doing consulting as well as auditing for Enron. Now they said either do consulting or auditing, not both. So you can either do consulting, you don't need to be independent for that, that's just fine. But if you're doing auditing, you need to be independent. You cannot do consulting. Consulting impairs your independence. Now, how about tax services? Now, for non-issuers, we said if you're doing auditing, tax services is okay because taxes and financial statements go hand in hand and we don't mind the auditor doing taxes. Now, in case of SOX, it requires that if you're doing tax services, make sure it's pre-approved by the audit committee. The audit committee pre-approves that yes, you can do the audit as well as taxes. And it is disclosed to the SEC, to the Securities and Exchange Commission. Very important. Now, along with auditor independence, SOX requires audit committee pre-approvals and communications. So SOX requires that all services provided by the auditor needs to be pre-approved by the audit committee. There's also a requirement for a lot of communications which go into the audit committee. Now, what is the audit committee? So you have the client having a board of directors and a management. So the board of directors, they hire the management, they oversee the management. A lot of times, even the management, the CEO, CFO, they are a part of the board of directors. Now, the rules require an independent audit committee. An audit committee or the board of directors which is not taking part in the management role. So you have people in the board of directors who may be taking part in the management role who are independent. So you form an audit committee out of those independent board of directors so that they can take care, they can oversee the audit function of the company. They can make sure the internal audit is working fine and the audit committee appoints the external auditor. The audit committee has a lot of communication going on with the auditor. So let's say the auditor has some problems with the management. They see that the management is having a scheme of money laundering, let's say. In that case, they go to the audit committee, which is independent of the management, and tell them, look, there's a fraud happening out there, and the audit committee takes appropriate action. So that is about the audit committee pre-approval, audit committee communications. Now under SOX, there is also a requirement for auditor or audit partner rotation. So SOX requires that the audit partner needs to rotate off the audit every 5 years. So let's say I'm a partner in an audit firm and I'm doing audit for a client. After 5 years, I need to get off that audit and some other partner would take care of that audit. Note, this is an audit partner rotation, not an audit firm rotation. So the firm would remain the same. Basically what happens is there's a permanent file in audit. The firm, the CPA firm, gets a lot of understanding about the company. So they don't want the firm to go on and off. They don't want a new audit firm every year, but the audit partner changes every 5 years. So it's like, I'm the audit partner. I know the CEO so well. We become friends as we do audits over the 5 years. After 5 years, I'm taken off so that my independence is not impaired. So guys, this audit partner rotation is very important and comes under title 2 of SOX. Now let's talk about the third title in SOX. The third title focuses on corporate responsibility. Now, I already told you about the audit committee. So we have an audit committee, an independent audit committee, which makes sure that corporate responsibility is followed, which makes sure that management acts in the best interest of the shareholders. There is no false profits, there is no fraud happening. Now, they have very strong provisions under SOX. It says Rule 302. So it's Title 3 and it becomes Rule 302 of SOX, which requires management to maintain proper internal controls. Guys, remember when I introduced GAS to you, I said management is responsible for the financials. We as auditors, we are responsible for our opinion on the financials. We are not directly responsible for the financials. Now, under SOX, they said it's a big company, right? Public company, issuers. They need to have strong internal controls that create these financials. So it says management has responsibility for internal controls, and it's very important to have those strong internal controls over financial reporting. Under corporate responsibility, they have another very important rule, 303. Now, this rule requires that management should not try to improperly influence the auditor. They should not try to make the financial statements misleading. So it says no improper influence on auditors. So guys, we are trying to instill a strong sense of corporate responsibility. I told you, right, after the frauds for Enron and Arthur Andersen, there was a question on corporate responsibility. There was a question on the CPA profession. So we're making sure everything works well. The management, they are more responsible, and the auditors, they again are much more responsible. They keep up, they live up to the profession. They live up to being certified public accountants. So you have corporate responsibility or having an independent audit committee that makes sure there is a lot of corporate responsibility, corporate governance out there. 302, management responsible for internal controls. 303, it says no improper influence on auditors. We can also add this point of no insider trading. Now, what SOX is, think about it. There is a sign there which says no littering. In another place, there is a sign, no littering, fine, 10,000 bucks and 1 year in jail. Guys, that is what SOX did. It said what already existed, but it clearly said, if you're doing this fault, this is what your penalty is. This is the fine that you have to pay. This is the number of years you have to spend in jail. They made it very strict. So it said no insider trading. Everybody knew that even before SOX came, but now the rules became much more stringent. The penalties became more pronounced. So we have insider trading provisions in Title 3. There's a little bit more in Title 9 where you have the white collar penalties. We'll look at that when you're going through the book. Now let's look at the next SOX title, Title 4. So Title 4 is basically dealing with enhanced financial disclosures, enhanced disclosures. Remember we said the management gives us the financials, we as auditors express our opinion on the financials. For the internal controls, we decide how good the internal controls are to decide how much of test of controls to do or substantive test to do. Now, SOX came up with a requirement for integrated audit. Now this is an audit of financial statements integrated with an audit of internal controls over financial reporting. So guys, we as auditors, we are now not only auditing these financials, we are also auditing the internal controls that the management has in place to create these financials. So it's an integrated audit. We integrate the audit of financial statements with an audit of internal controls over financial reporting. We express two opinions. We express one opinion on these financials, whether these financials are true and fair, and we express a second opinion on the internal controls that create these financials or the internal controls over financial reporting. Guys, this is the importance that SOX has brought to internal controls. If internal controls are strong, the financials, there's a higher chance, a higher probability for these financials to be true and correct. So there's a lot of focus on internal controls. Here we said management is responsible for internal controls, and here we are saying that the auditor not only audits the financial statements, he also audits the internal controls over financial reporting. So this comes under Rule 404 of SOX. So you have Rule 302 which says management, you are responsible for internal controls. 404 says auditor, you're not only doing a financial statement audit, you are integrating that financial statement audit with an audit of internal controls over financial reporting. Guys, this is very important. We'll talk about this again in audit 3 when you're doing internal controls. We'll look at auditor reports when the auditor has an option of either issuing separate reports. One report on the financial statements, the other report on the internal controls over financial reporting. Or the auditor can give both the opinions on a combined report. We'll talk about that. Now under Title 4 enhanced disclosures, there's also a requirement for real-time disclosures. So you have real-time disclosures of material events to the SEC. So the company is required to have real-time disclosures. I mean, if there's any material event which happened in the company, let's say the CEO resigned, there's some trouble, you need to disclose it real-time to the SEC so that everybody knows about it. So guys, this is basically what the SOX structure that we have on the CPA exam. Very important. I'll just go over it quickly once again. So you have the Sarbanes-Oxley Act in 2002, very important act. Create a lot of new rules, made sure that the management is responsible and the auditors are responsible. It created the Public Company Accounting Oversight Board to oversee the auditors of issuers. The auditors of issuers are required to be registered with the Public Company Accounting Oversight Board, which also has its bunch of auditing standards, which is GAS plus more. Then you have Title 2 providing more stringent rules for auditor independence. It says an auditor cannot provide non-attest services like consulting to an audit client. It requires auditors to have audit committee pre-approvals, make sure that there is ongoing communication with the audit committee, requires audit partner rotation every 5 years. Title 3 of SOX makes sure that the management, they are more responsible, corporate responsibility. There's an independent audit committee. It makes sure that management is responsible for internal controls. It provides that management must not improperly influence auditors. Certainly no insider trading. Title 4 talks about more enhanced disclosures. So you have auditors doing an integrated audit, an audit of financial statements integrated with an audit of internal controls over financial reporting. Guys, two audits, two opinions, all integrated into one. So guys, this is about SOX. Let's look at the book and we'll come back and talk about the Public Company Accounting Oversight Board and the SEC, the Securities and Exchange Commission. Let's get to page 19 where we are looking at the Sarbanes-Oxley Act of 2002. On the top of this page, I want you to make a note which says SEC/SOX/PCAOB is equal to issuers. So whenever we're talking about the SEC, that's the Securities and Exchange Commission, SOX, that's the Sarbanes-Oxley Act of 2002, or the PCAOB, that's the Public Company Accounting Oversight Board, we're talking about issuers. We're talking about companies which issue securities. Guys, we're talking about public companies. Let's read now. It says SOX was created in 2002 to restore investors' confidence. SOX established the Public Company Accounting Oversight Board. Next one says SOX led to integrated audits where we're not only auditing the financial statements, we're also looking at internal controls over financial reporting. Now this is only for issuers, as I told you. Now in the middle of the page, you have 4 boxes there. That's the first 4 titles of SOX. Now SOX actually contains 11 titles, but for the CPA exams, the focus is on the first 4 titles. So SOX Title 1, that deals with creation of the new board, the Public Company Accounting Oversight Board. The second title talks more about auditor independence. Title 3 of SOX, that deals with corporate responsibilities. Title 4 requires enhanced financial disclosures. So let's get to the next page, page 20, and start with SOX Title 1. Highlight on the top of the page. Title 1, PCAOB. And right there, audit standards for issuers is equal to PCAOB AS is equal to GAS++. So guys, when you're going out and auditing issuers, you're following the Public Company Accounting Oversight Board's auditing standards. So when the Public Company Accounting Oversight Board was created pursuant to SOX, they started with the GAS rules and they said we're going to add more rules to that. So that's why we say it's GAS plus more, GAS++. So 101 under Title 1 says establishes the new board PCAOB, which consists of 5 full-time members, of which 2 are CPAs and 3 non-CPAs. All these members are appointed by the SEC. 102 says, highlight this one, public accounting firms must register with the PCAOB in order to perform audit functions. Write a note there which says, only CPA firms registered with PCAOB can audit issuers. Next highlight, PCAOB to establish audit standards, quality control standards, and ethics standards. So all these standards which will be used by registered public accounting firms in preparation and issuance of audit reports. It says PCAOB also inspects, investigates, and disciplines public accounting firms and enforces compliance with the Act. So as I told you, audit standards either by the AICPA or the Auditing Standards Board of the AICPA or the PCAOB or a combination of the two. That's why we said GAS++ or PCAOB's auditing standards. Next bullet is you have must keep work papers or audit documentation for 7 years. Highlight this, work papers, audit documentation for 7 long years. Next bullet, highlight second partner is required to review. So we're going to talk about this when we get to audit 4, but a second partner review is required before you issue out an audit report. Then you have audit reports must describe the scope of testing for internal control. We look at reports on internal controls over financial reporting. Next you have PCAOB to conduct peer reviews, highlight peer reviews. And deficiencies discovered are reported to the SEC and made available to the public. It says performed every year for firms that provide more than 100 audit reports annually, and every 3 years if the CPA firm provides less than 100 reports annually. Then you have PCAOB, which is a lot of authority. It's got authority to subpoena all information. Then you have 106, which requires public accounting firms that prepare audit report for any issuer to comply with PCAOB requests. 107 says that SEC has oversight and enforcement authority over PCAOB and its decisions. 108 says that FASB has authority to adopt accounting standards. FASB creates the US GAAP. And then you have PCAOB and FASB to be funded from fees imposed upon public companies. Let's get to the next page, page 21, and we're looking at the very important SOX Title II Auditor Independence. Highlight Title II Auditor Independence. And let's make a note on the top of this page. Right, for each public client, so as a registered public accounting firm, each public client choose any one. Audit services or consulting non-attest services. Cannot do both. Once again, for each public client, choose any one. Either you can give audit services or you can do consulting or non-attest services. First line, highlight prohibits. So SOX prohibits any registered public accounting firm from providing the following, highlight non-audit services to their audit clients. So again, these are similar to what we've learned under the AICPA code, but it's much more stringent here. So you have bookkeeping or other services, financial info systems design or implementation, appraisal or valuation services, fairness opinions, actuarial services, internal audit outsourcing, management functions or HR functions, broker or dealer investment advisor or investment banking services, legal services and expert services, any other service the board determines impermissible. And then you have a star there, highlight tax services permissible. But there are two conditions there. Underline them, pre-approved by audit committee and underline disclosed to SEC. Next line, highlight audit committee pre-approval. So for all auditing and non-auditing services that CPA firms may provide to issuers, it needs to be pre-approved by the audit committee. Next, highlight audit partner rotation every 5 years. So every 5 years, the partner on the audit engagement needs to be changed. Next, highlight communications to audit committee. So auditors are required to communicate all critical accounting practices, policies, and alternative treatments, and these communications to audit committee must occur on a timely basis. Then you have SOX prohibits the audit firm from providing audit services for issuer if CEO, controller, CFO, CAO, or any person serving in the equivalent capacity was employed in the audit practice of the accounting firm during the 1 year period prior to the audit. Highlight here, CPA firm to audit a test client, last 1 year called cooling off period. So as we learned under the AICPA code rule 101, if you were working in the CPA firm as an auditor and you join the audit or a test client and you're having a key position at the client, the CPA firm will lose the audit client for 1 full year. That 1 year period is called the cooling off period. On page 22, highlight Title III, Corporate Responsibility. Each issuer needs to have underline an independent, highlight audit committee. And right there, audit committee equals no role in management. So audit committee comprises of a few independent directors from the board of directors who have no role in management. Next, highlight section 302, which requires that highlight management, including the CEO and the CFO, certify periodic reports filed with the SEC, where officers are responsible for the financial statements and highlight officers are responsible for internal controls. And right there, management responsible for internal controls. Highlight section 303, improper influence on conduct of audits, which prohibits any officer or director of any issuer to fraudulently influence, coerce, manipulate, or mislead the auditor for the purpose of rendering such financial statements materially misleading. Then section 306 highlight prohibits insider trading by officers or directors during a pension fund blackout period. Get to the next page, page 23, and we're looking at SOX highlight Title 4 Enhanced Financial Disclosures. So 402 under Title 4 prohibits personal loans to directors and executive officers. 403 talks about directors, officers, and 10% plus stockholders. Put a bracket around this and draw an arrow which says related parties. So guys, SOX Title 4 says that all these related parties, they are required to disclose stock transactions within 2 days. Highlight the next one, 404. Auditors required to attest to management's assessment of effectiveness of internal controls over financial reporting. Very important. And put a note here which says integrated audit is equal to audit of financial statements F/S plus audit of ICFR, that's internal controls over financial reporting. So it's an integrated audit when the audit of internal controls over financial reporting is integrated with an audit of financial statements. Then you have rule 406, which talks about the code of ethics. 407, it says must disclose whether highlight at least one member of the audit committee is a financial expert. You're not required to be a CPA to be a financial expert, but generally if you're a CPA, you are a financial expert. So guys, be all set to become financial experts. Next one, highlight real-time issuer disclosures. So rule 5 not, just cut it here, Shivam, very slight cut, huh? So rule 409 says that issuers must disclose material changes in the financial condition or operations on a rapid and current basis. Turn to page 24, where we've got the remaining titles of SOX, titles 5 through 11. On title 8, highlight Corporate and Criminal Fraud Accountability Act of 2002, which makes it a felony to knowingly destroy or create documents, including audit working papers, to impede, obstruct, or influence any existing or contemplated federal investigation. It says that highlight auditors are required to maintain all audit working papers for 7 years, and which provides for highlight whistleblower protection for employees of issuers who provide evidence of fraud, and of course highlight criminal penalties for securities fraud, which includes fines and or up to 25 years in prison. Title 9 includes highlight white collar crime penalty enhancements. Section 906 is about highlight corporate responsibility for financial reports, which requires the CEO and the CFO to certify periodic reports filed with the SEC. For example, the annual 10K, the quarterly 10Q, and there are highlight criminal penalties for willful violation. Again, up to $5 million in fines and or up to 20 years of jail time. On page 25, we are looking at a few other related acts. The first one here highlight the Private Securities Litigation Reform Act, which was passed way back in 1995, which requires auditors of issuers to detect related party transactions, highlight illegal acts, and highlight going concern issues. Now, for illegal acts, it requires auditors to investigate and quickly notify that illegal act. So the auditor shall inform management and ensure that the audit committee or the board of directors is also adequately informed. The board needs to inform SEC by next business day and furnish a copy of the notice to the auditor. Now, if the board does not do that, then the auditor directly goes to the SEC within one business day after that. So right there, auditor goes to board of directors, who then inform the SEC. If the board does not do their job, then the auditor directly goes to the SEC under the Private Securities Litigation Reform Act. Now, over the years, the US Congress has exempted certain issuers from integrated audit requirements. So right there, no integrated audits required for, and underline the Dodd-Frank Act of 2010, which exempted issuers classified as non-accelerated filers from complying with the integrated audit requirement. Now, a non-accelerated filer is a company with a public float of less than $75 million. Next, we have underlined Jobs Act of 2012, which exempted issuers defined as emerging growth companies from complying with integrated audit requirements. Now, emerging growth companies or EGCs are companies allowed to go public via an IPO with relaxed compliance requirements for underline the first 5 years, as if an IPO on-ramp. So now we've seen SOX or the Sarbanes-Oxley Act of 2002. Let's talk about the Public Company Accounting Oversight Board, which we know now has been created by SOX. So SOX created the Public Company Accounting Oversight Board. Now, as the name suggests, it's Public Company Accounting Oversight Board. It oversees the accounting, the auditing, the test services for public companies. It oversees the auditors of issuers, which first need to register themselves with the PCAOB. So before you go out and audit an issuer, you have to register yourself with the Public Company Accounting Oversight Board. Now, as far as the audit standards are concerned, I told you we have the Public Company Accounting Oversight Board's auditing standards, which is nothing but GAS++. So it's GAS plus more. Now, as we know, the Public Company Accounting Oversight Board auditing standards have provisions for integrated audit. That's an audit of financial statements integrated with an audit of internal controls over financial reporting. This is something that we have right here. So you have integrated audit that's required by SOX, comes under the purview of the Public Company Accounting Oversight Board's auditing standards. So as an auditor, you look at the financial statements as well as the internal controls that create these financial statements. Now, the PCAOB's auditing standards has more stringent requirements for your field pick. So your fieldwork standards are much stronger as compared to what they were in GAS. So you have increased focus on audit risk, audit documentation. There's an EQR provision, that's an engagement quality review. That's the final review before the audit report goes out. So there is an audit partner who takes care of the audit engagement. Before the audit report can go out, the report of the audit partner needs to be reviewed by another concurring partner. It's called a process of an engagement quality review. The conquering partner sits down with the engagement team, understands what has been done and reviews before the report is actually given out. So that makes sure that there is a proper quality control before the audit report goes out. Now, the Public Company Accounting Oversight Board also has its own ethics standards. Now, we do follow, the PCAOB also follows the AICPA code and adds to that. So, you follow the AICPA Code of Professional Conduct, Rule 101, independence applies. 102, integrity and objectivity, it applies. Now, since this is issuers, it's more stringent. So, the ethics rules also require that you do not violate the SEC's securities laws. So you have stuff out here. So you have rules relating to auditor independence, which is again enforced by the Public Company Accounting Oversight Board. It says no non-attest services, no consulting. Tax services, that may be okay if it's pre-approved by the audit committee and disclosed to the SEC. Now under tax, there's a couple of points that you need to know. Though you may give tax services to the company, so if it's pre-approved by the audit committee, disclosed to the SEC, you can do audit as well as taxes together. But you cannot provide tax services related to certain confidential or aggressive tax transactions. That's rule number 1. Number 2, you cannot provide tax services to corporate offices of the client or their immediate families. So guys, once again, first thing, it's not so easy to provide tax services. Before you provide tax services along with attest or audit services, you need to have it pre-approved from the audit committee and disclosed to the SEC. Even after you get such approvals and disclosures, make sure that you are not providing tax services for any confidential or aggressive tax transaction. Also, make sure that as an auditor, if you're an auditor of an issuer, you do not provide tax services to corporate offices or the immediate family. So guys, as we see, you have the audit standards getting more stringent. Earlier we had GAS, now we have the Public Company Accounting Oversight Board's auditing standards, more stringent. The ethics requirements are also getting more stringent. We just had the AICPA code. If it's a non-issuer, for an issuer, you have the Sarbanes-Oxley Act, which has a bunch of provisions. Public Company Accounting Oversight Board enforces those provisions. You have the SEC or the Securities and Exchange Commission also enforcing the SOX provisions. Guys, lot of content out here, and you just need to understand the way we're going on. On page 27, we're looking at the PCAOB or the Public Company Accounting Oversight Board. Make a quick note on the top right, SEC or SOX or PCAOB, and you know we're talking about issuers. As we know, PCAOB was established by SOX. Public accounting firms must register with the PCAOB before they can audit issuers. Right there, PCAOB standards. So the PCAOB establishes standards for, put a box around, auditing, box attestation, quality control, and ethics. And these are the standards which are to be used by registered public accounting firms when they are auditing or providing attest services to issuers. Highlight PCAOB to conduct continuing inspections to assess the degree of compliance of each registered public accounting firm. In conducting an inspection of a registered public accounting firm, the PCAOB shall inspect and review underline selected audit and review engagements of the firm. May include audit engagements that are the subject of an ongoing litigation or another controversy. The PCAOB shall evaluate the sufficiency of underline the quality control system of the firm. The PCAOB shall perform other underline testing of the audit, supervisory and quality control procedures of the firm as necessary or appropriate. These inspections are to be conducted every year for firms that provide audit reports for more than 100 issuers annually, and for every 3 years for other firms. Underlying deficiencies discovered are reported to the SEC and made publicly available in appropriate detail. Next highlight, PCAOB may conduct investigations and disciplinary proceedings. Basically, the PCAOB has got authority to subpoena information, require testimony of registered firms or associated individuals. They've got authority to temporarily or permanently suspend auditors, revoke their registration or impose penalties. And on the next bullet, highlight PCAOB AS. So that's the PCAOB's auditing standards. Turn to page 28 and put a box around PCAOB AS. And right there, PCAOB AS equals gas plus plus. So when SOX was passed in 2002 and PCAOB got created, the PCAOB adopted gas standards in the interim and modified them as necessary by issuing additional standards. Now, effective December 2016, PCAOB reorganized its auditing standards. And you have underlined general auditing standards. That's the general tip. And we'll cover that in audit 0 and 1. When you talk about independence for audits of issuers, we are looking at the AICPA code plus SOX plus SEC regulations. Highlight engagement quality review, which is a second partner's review and approval of each audit. Now, this is required under PCAOB auditing standards, but not required per GAS. Next, you have underlined audit procedures, and we'll cover that in audit 2, 3, 4, and 5. Highlight an audit of internal control over financial reporting ICFR that is integrated with an audit of financial statements. Now, integrated audit is required under PCAOB AS, but optional for non-issuers per GAS. Let's get to page 29, where we have underlined auditor reporting. And we'll cover this in audit 6, where we've got reports on audits of financial statements. Now note that the PCAOB AS report format is different from GAS. So when we get to audit 6, we're going to look at all the GAS audit reports, and then on the appendix, we will have the PCAOB audit reports. The PCAOB auditing standards also include underlined matters which relate to filing under the federal securities laws, and they are underlined other matters associated with audits. Let's now talk about the SEC, or the Securities and Exchange Commission. The SEC enforces the securities laws in the US. These come from the Securities Act of 1933, the Securities Exchange Act of 1934. Basically, the 33 and 34 Act were passed in the backdrop of the Great Depression, which started in 1929. As a matter of fact, even the SEC itself was created out of the 1934 Act. Now, you have a bunch of more securities laws coming up over the years, one of the most important ones being the Sarbanes-Oxley Act of 2002 that we have here. So, it's SEC which also enforces the SOX or the Sarbanes-Oxley Act. SEC regulates national exchanges, it regulates issuers, public companies. So, if a non-issuer wants to become an issuer, it needs to file a Form S1 registration statement with the SEC. Even after becoming an issuer, there's a lot of periodic filing which goes into the SEC. Something like 10Q, which is quarterly reports, 10Ks, annual reports, 8Ks, any important event. So guys, SEC basically regulates the issuers. SEC is responsible for enforcing SOX, enforcing the securities laws. Very important. On page 31, we've got the SEC. And right there, SEC, SOX or PCAOB, all these relate to issuers. Now the SEC is responsible for administering the major securities laws in the US, which include highlight the Securities Act of 1933, highlight Securities Exchange Act of 1934, and underline this is the act that created the SEC. Draw a bracket around the 1933 and 34 Act and write Reg, because that's where we'll cover these acts in a lot of detail. Highlight the Sarbanes-Oxley Act of 2002. Draw an arrow and write Audit, Reg and BEC. SOX is all over the place. We're going to learn about SOX in auditing, in Reg and in BEC. Then you've got the Dodd-Frank Act, which we'll cover in BEC. And then Jobs Act of 2012, that's the Jumpstart a Business Startups Act. We'll cover that in Reg. Now SEC, highlight Regulation SK, lays out reporting requirements for various SEC filings and registrations. Now, it is closely related to highlight Regulation SX, which lays down the specific format and content of the financial statements. So your audit is out here. When you go out and audit a non-issuer, you're following GAS, the Generally Accepted Auditing Standards. In other words, you're following the Auditing Standard Board's Statements of Auditing Standards, or the AU code on your research simulations. Now, it's the Auditing Standard Board's Statement of Auditing Standards, which is based around the GAS framework, that we have here on the board. When you're going out and auditing an issuer, public company, you're following the Public Company Accounting Oversight Board's auditing standards. Now, let's say you're going out and doing an audit of an employee benefit plan. You are also required to comply with the Department of Labor rules. When you go out and audit a governmental organization or entities that receive federal financial assistance, you are also required to comply with the Governmental Accountability Office or the GAO rules. Let's see that on the book. On page 33, we're looking at highlight Department of Labor or DOL, which establishes, put a box around, independence guidelines for CPAs auditing underline employee benefit plans under highlight ERISA, that's the Employee Retirement Security Act of 1974. Now, one of the pointers here is that highlight the CPA auditor is not independent with respect to the employee benefit plan if highlight committed to acquire any direct financial interest or any material indirect financial interest in the plan or the plan sponsor. Turn to page 34 and highlight Governmental Accountability Office, the GAO, which issues highlight GAS or Generally Accepted Government Auditing Standards, which is also called highlight Yellow Book. Now put a box around independence requirements per GAS, which requires that the auditor should be independent, highlight both in mind and appearance. Highlight the GAS conceptual framework for independence, which again requires the auditor to identify underlying threats to independence and then apply underlying safeguards as necessary to eliminate the threats or reduce them to an acceptable level. Now, talking about government auditors and audit organization structure, often highlight audit organizations that are structurally located within government entities are subject to constitutional or statutory safeguards that mitigate the effects of structural threats to independence. On page 35, we're looking at general requirements for highlight performing non-audit services for an audit government client, where the auditor should highlight consider management's ability and intent to effectively oversee the non-audit service which the auditor is planning to perform. Now, auditors performing non-audit services for audit clients should highlight obtain assurance that the audited entity management performs the following functions in connection with those non-audit services. Underline assumes all management responsibilities, oversees the services, evaluates adequacy and results of the service performed. So guys, these are certain requirements when the auditor is performing certain non-audit services for the same audit client.